All right, let's talk about Angi's latest earnings call for Q2 2025. It was a fascinating one. You had these mixed headline numbers, right? But the market's reaction? Not mixed at all. The stock just took off. So we're going to dig in and figure out exactly what happened.
And yeah, when I say it took off, I mean it really took off, up over 16.5%. But here's the real head scratcher. This massive jump happened even though Angi actually missed on earnings per share. So that's the big question we're tackling today. What on earth did investors see that made them ignore that EPS miss and hit the buy button so hard?
Okay, so here's how we're going to break it all down. First, we'll hit the Q2 scorecard. Then, we'll get into the story of what I'm calling a tale of two Angis. After that, we'll look at their big plan for profitable growth by 2026. And we'll wrap it up with our take, the next call.
So, Section 1, the Q2 scorecard. Let's start with the raw numbers, the stuff that caused all the initial confusion.
Okay, so look at this. You can see the conflict right here in black and white. On the one hand, they beat on revenue, and not by a little bit. They brought in $278 million, which was a good 6% over what the street was expecting. Solid. But then you look at GAAP EPS. A miss. They came in at 23 cents a share when consensus was looking for 26. That's a pretty big miss, about 11.5%. And their adjusted EBITDA was down from last year too. So you've got this classic beat on the top line, but a miss on the bottom line.
So here's the disconnect, visualized. You've got this nice revenue beat, a solid green bar, but right next to it, a pretty ugly EPS miss. Now, normally, a report like this might get you a flat day, maybe even send the stock down a bit. But like we said, that's absolutely not what happened here. To figure out why, we have to pop the hood and look at what's really going on inside the company.
And that brings us to the real story, the one the market was paying attention to. It's this massive pivot from quantity to quality. It really is a tale of two Angis right now.
So on the left, think of that as the old Angi. That's their network channel. It's all about broad volume, but lower quality. And management is intentionally letting that part of the business shrink. Now look to the right. This is the new Angi, the proprietary channel. The focus here is all about jobs done well, about quality. And this is what got investors excited. For the first time since 2021, this part of the business is actually growing. Service requests up 7%, leads up 16%, revenue per lead up 5%. You see what they're doing? They're trading empty calories for real, sustainable nutrition. That's the pivot. And listen, don't just take my word for it. The CEO, Jeff Giff, said it himself on the call. He pointed out that they've shed over $400 million in revenue over the last few years. Now, to most people, that sounds absolutely terrible, right? But he said, and I quote, "We would actually argue it is all a very good thing." Think about that. They were basically pruning the business, cutting off the dead branches, unprofitable marketing, low-quality jobs. They were actually draining the life out of the company. This is a classic case of addition by subtraction.
Okay, so we get the what and the why. The strategy is to focus on quality, not quantity. But what about the how? How are they actually going to pull this off and hit that 2026 target for profitable growth?
Well, on the call, management laid out a pretty clear three-step plan. First up, rebuilding their tech. They're using new Q&A technology and even a large language model, an LLM helper, to get way better details from homeowners about the job they need done. Step 2, they're finally consolidating all their service pros onto one single modern platform. You can imagine how much more efficient that's going to be. And third, they're launching online pro enrollment here in the US. This is a model that's already been a huge home run for them over in Europe. It all boils down to one thing: creating better matches between homeowners and high-quality pros.
And you might be asking, is any of this actually working yet? Well, here's the proof in the pudding. Check out these pro acquisition numbers. In Q2, they actually acquired 39% fewer new pros than last year. Okay, sounds bad, right? But wait, the total lifetime value, the LTV, of all those pros they signed up, it was only down 4%. You see what that means? The average value of each new pro they're bringing on board has just skyrocketed. Their efficiency metric, that LTV to CAC ratio, has jumped all the way to 2.8x. This isn't just theory anymore. This is a clear sign the pivot is actually working.
All right, so that's the story so far. We've got the strategy, we've got the early results. So for our last section, it's time to put on our analyst hat for the next call. We're going to give you our prediction, a rating, and even a trade idea. So the big question on everyone's mind: what is the verdict on Angi stock right now?
Okay, here's our take for Q3. We think the core story continues. The good part of the business, that proprietary channel, should keep growing, while the old network business starts to stabilize and find a bottom.
Revenue will probably be fine, but the real thing to watch, the thing everyone will be focused on, is margin execution. As for the stock price, look, after a pop like that, we think it's going to be pretty range-bound for a while, probably bouncing between 18 and 20 bucks a share. The market's going to want to see more proof. So our rating on the stock is market perform. The big, easy pop is over. Now comes the grind of execution.
But just because we're calling it market perform doesn't mean there isn't a more interesting, let's call it a speculative trade on the table. So let's talk about the trade idea.
So here's the setup. The catalyst is that the parent company, IAC, is planning to spin off its remaining stake in Angi in the first half of 2025. Now, here's our thesis. Once that spin is done, you're left with a clean, independent Angi. All this painful restructuring will be behind them. And you know what that looks like? It looks like a prime acquisition target for either private equity or maybe another strategic buyer. The company will be so much easier to value and digest. So what's the trade? You could look at buying long-dated call options. I'm talking way out, like January 2027 expiration. The idea is to capture that potential M&A premium well after the spin-off dust is settled. It's a plausible long-term bet.
So there you have it. That's our deep dive into Angi's quarter. And as always, just a reminder, this is not financial advice.